You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where we do our best to bring you into the world of rules-based investing by sharing our knowledge and hard-learned lessons over the last few decades, hoping that you can avoid making some of the mistakes that we did. As usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Hi, both. How are you keeping?
Doing well. Good morning. Good afternoon.
Yeah, keeping well. Adjusted to European time again, so that's always nice after our New York adventure. Just a couple of things that sort of caught my eye. Of course, Friday was the first day of November, so when I look at some of these events, they probably cover more the month of October. But of course, we had a late in the month rate cut by the Fed, so we saw definitely more risk on trades in October, which made the sell-off in fixed income markets continue for a while longer, and I'm sure that it's one of the struggles that trend followers in general had. But of course, other than that, we see a change of the Lagarde, so to speak, at the ECB. We still have the uncertainty about US-China trade relations, and now we know that we're going to have a Christmas election in the UK. So it seems to me like the current decade, which when you think about it, is only 2 months longer than this decade is over, still might throw some interesting stuff into the markets, some surprises, as it usually does. But anyway, other than that, I nothing that kind of stood out completely, Moritz. So always interested to hear how your week went in the trend following world.
Yeah, I'm up a teeny tiny bit, but it's really been back and forth this past week. One day up, one day down, up again, down again, and then up again. But what I noticed is that some of my positions, they started moving. So I've reduced for the first time in a long time some of the longs in the bonds, right? So I'm now less long of JGBs, less long of 10-year notes, even of the boons, which have been performing so well in the past couple of months. So that has changed a bit. I'm also getting less long the dollar. That's one of those positions which I had strongly long for pretty much most of the year, especially against, Australian dollar, but also against the euro. So I still have that long position, but not to the full extent anymore. And in equities, it's one of those markets where, the observer may sit there and say those things are trading super high, but what is super high? It's all subjective talking. You have to get in if those things are making new highs, and equities have been making new highs. So I'm getting longer in those equities. Again, Nikkei, mid-cap, Dow Jones, all of those, even DAX, a bit more on the long side. So the portfolio has shifted a bit, not, massively, but, it changed. And like you said, Niels, we'll see what the last 2 months of the year will bring with some vote in the UK ahead of us and Brexit, yes or no, who knows, a new ECB president, impeachment, you name it. It's a box of presents.
It is a box of presents, absolutely. I mean, I guess on our side, perhaps the most exciting thing was at the end of October, meaning end of Thursday, that completed 45 years of continuous track record on our side. But of course, the month of October was exactly like the previous 44 years and 11 months, full of surprises and unpredictable news. As you mentioned, I mean, there were some strong U.S. markets on the back of the unemployment news, and so equities did well for us. And actually, we've been ramping up equity exposure for the last month or so in particular. So that's actually our largest exposure now. It's taken over, like on your side, a little bit more. It's taken over fixed income, which also have seen somewhat of a reduction in the last week or so. So kind of similar picture on our side. In terms of P&L for the week, probably slightly down maybe for the week. Actually overall fixed income did okay for the week, even though they eased off a little bit yesterday. Equities did okay. Nat gas, bit of a challenge for us with its 10% up move during the week. Coffee, bit of a challenge for us for sure. Currencies, probably consistently across the currency sector. We saw some give back with the weaker dollar. Nothing else stood out. Made a bit of money in gold and silver, but nothing too noticeably. So, interesting what the last couple of months will give us. Still a good year, but certainly a down month in October, following a down month in September. So kind of a natural reaction or correction, I think, on the strong run we saw in the beginning of the year. Pretty much what we saw. What about you, Jerry?
Not a lot of changes, trend position-wise. Long bean oil, but the only grain I think we're long. The currencies, they're still long the dollar, and then except against Mexican peso, Russian ruble made new highs, I think, this week. I looked at all the stocks, and they're just, they just look different. Some are sideways, some are making new highs. We got long Tesla, first time ever. On that one, had a big, crazy up move. I looked at the indices, the sub-indices of the S&P, like 10 different major, and they're all in pretty much all-time highs except, I think, energy. So that was kind of interesting. I don't subscribe to more trend equals more trend necessarily, but it's just what's happening. Silver and gold are hanging in there, platinum, palladium, awesome. Haven't done anything in energy in a long time. Got out of my cocoa long at the lows, so I'm kind of rooting for it to go back down. That was like one of the first things I was told, don't root and don't remember these positions that you just got stopped out of and stuff. So still haven't learned that lesson. Got looks like lead and nickel are hanging in there on the long side. Got flat my zinc short, and then everything else, copper and aluminum was short. So it's and probably the biggest negative mover was cattle. The cattle rally from the shorts that didn't work out. So, but not a lot of change. Just small. I like it that way.
That's funny you say this thing about getting out and then hoping the market will go back down. I mean, we know from the academic world that the pain of loss feels twice as worse as the joy of gain. But I think actually it may come to a surprise for many people that actually regret is even worse. Because with regret, we look back and we second guess our decisions, and the emotions around that decision don't fade. I mean, I know we're rules-based, but if it was a discretionary decision. So it kind of continues to sit inside us. I just hope at least that people won't regret that they don't have enough exposure to trend when it's going to be needed sometime in the future. We'll see about that. Now, I heard some rumors, Jerry, that we may have a new all-time high in Twitter likes as well, or love for one particular tweet as well. So it's not just the equity markets making new highs.
No, it's just like the markets. You just don't know where it's going to come from. Before I push the Twitter send, all the time I'm like, is this really worth it? Is this going to be a good one, a big one? I mean, sometimes I really like them, and I get 2 likes, and one is you and one is Moritz. So great. Sure. And then sometimes, out of nowhere, it strikes a nerve. This one I got out of the irrelevantinvestor.com. And he talks about the best thing to follow is kind of trend, all-time highs. And at all-time highs, he says, so everyone is bullish, right? Hardly. Per Barron's, 27% of money managers are bullish on stocks over the next 12 months, the lowest in 20 years. All-time highs makes people more cautious. And I just remembered kind of a pithy quote from 1983 that goes something like, people have a tendency to be hopeful with their losses and afraid with their profits. And this is the reason why I think trend following works. And then the trend following way of looking at life is if you have a small loss, you should be fearful that it's going to turn into a bigger loss. And if you have a nice profit, you should be hopeful that it's going to turn into a bigger profit. And I think everyone talks about following the rule, taking small losses, but equally, if not more important, is don't take small wins. Let your winners be bold with your winners. And this struck a nerve with people. They loved it. So that was nice.
It's interesting. I had a very, very long drive, a 14-hour drive on Thursday, and so I listened to a couple of audiobooks. One of them, I think it was called Outrageous. It's about what makes certain things more likely to be shared. Why do people share, and why does it go viral? And from memory, at least, what the author said, that things from their research, things that makes people more likely to share, could be on social media, but actually most things that are important doesn't get even shared on social media, which surprised me. But anyways, it's things that makes you go, like surprised, kind of, I didn't realize that's interesting. So it's actually quite a good, I haven't finished the book yet. I have to go on another drive in order to do that, I guess. But it's interesting. And as you said, you don't always know why things suddenly get a lot of likes.
No, it's for my followers, the closer I get to plain old trend following, the more they seem to enjoy the encouragement and validating their worldview, as do I. So I stray out into other topics and sports and politics. 0 likes. So there's a good lesson.
Cool stuff. And of course, the theme of that tweet, I mean, the fact that we should love our winners and we should, get out of our losers. Not surprising to any trend follower, but nevertheless, hard to do for most people, I guess.
Another thing that I don't particularly enjoy is bad-mouthing the stock trend. We talked about this before on air, and then you guys just told about increasing your equity positions, and it's just trends. We're just following those trends, whether it's indexes or single names. It's improving the portfolio to have this diversification of equities in there, and we don't think that we should be pigeonholed as just how are you doing when equities do poorly, but it's the perfect portfolio versus the perfect hedge. I'm not claiming to be perfect, but I don't think we're on this planet for one reason only, just to be a hedge, get a 5 or 10% allocation and be a hedge for something else. So
right.
The bonds are great. They're in an uptrend. We're making money. Some of the currencies, we made money on those trends. And hey, equities too. I don't want to root against the equities. Let's hope for another 2008 so it can all crash. We can relive those years again and make a lot of money. So I think it's kind of silly that trend followers do that.
I was just thinking about most of the people I meet, and when they speak about their portfolios and their trading, and they're not trend following traders, they trade equities, right? That's most investors' portfolio is equities. And because, they have no commodities, they don't have an active view on currencies. Sometimes it's difficult for them to get exposure to bonds because they're OTC and they're not trading futures. So it's really equities. And then they go like, well, equities are trading fairly high based on whatever metric. And, to your point, then you become afraid with the profits. We have the advantage of seeing equities as just one of so many positions over time that it's, I guess, easier for us to just, close our eyes, follow the rules, hold on to those equities, or even like I just did, increase the exposure to those markets because it's really just, one part of a larger thing. Whereas for most other people, it is the part of the one portfolio.
Yeah, I mean, I'd love to also weigh in on this. I mean, I think Jerry is right that it's very, it's dangerous when we start being pigeonholed with certain mandates. Like, what is your mandate? Well, my mandate is not to make money just because the equity markets go down for 4 weeks. That's not the mandate of our firm. It's not the mandate, I think, of most trend followers. Our mandate is to make absolute returns. And historically, they've turned out to be uncorrelated to stocks and bonds, not every day, not every month, but in the long run. And all academic research shows that those characteristics has a positive impact on a traditional portfolio. So I think the unfortunate thing is that when certain parts of the CTA world start promoting their own strategies, in the light of trend followers failing to deliver on their mandate. I mean, it's not a mandate defined by us. It's a mandate defined by them to fit their purposes. So I think we have to be careful with that. It's obviously very tempting right now, and it seems to be working to position your strategy as something that can make money when equities go down, like in February of last year, like in Q4 of last year. But you fail to look at the full picture when you just hone in on a few weeks. I mean, why would you be so concerned about making money for a few weeks? Why not be concerned about, like on our side, we've just completed 45 years of making money. Why wouldn't you be concerned about that? And I think that's what we need to get back to. We should get away from this short-term focus. We should get away from, quote-unquote, the crisis alpha mandate. I don't think we have that mandate. For those who do, for those who design their strategies to have that mandate, great. All power to them. Keep doing it. But we shouldn't blame others for that. And we shouldn't blame others for having conviction. Meaning, we're, as we talked about earlier today, we're, increasing our risk budget in equities because that's where the trend is. But that's because we have, quote unquote, conviction in those trends. There's nothing wrong with that. There's no one who can predict when equity markets will turn. And so as long as the trend is up, we need to be there. Same thing with fixed income markets in the last many, many years. It is the only right place to have made a lot of money. I mean, in fact, I would say if you did make a lot of money in fixed income in the last decade or so, you probably weren't a true trend follower. Or you could even argue that you didn't have your allocation of markets and risk and so on and so forth, fully straightened out. Because why would you have too much focus on other markets that weren't trending? So, again, I don't think there's anything wrong with having other mandates or specific mandates, to play a role in a portfolio. But we don't have to blame others who may have a different mandate and try and impose these restrictions or artificial classifications in order to make the case. Anyways, just my thoughts.
Well, I think it's just a cheap marketing tactic, low class, and to trade short term and to put yourself out there and reliably be somebody that can help out in a crisis, even if it lasts a few days or weeks. That's tough. It's much tougher than what I do. So can just being great to do that, can that be enough? Can you kind of leave me out of it? And you could talk and laugh and say, oh, it's so cute that you still have to do long-term trend following. But just enjoy your own ability and this little world you've created and how you market and sell yourself versus readjusting history. As when we came out of the womb, we had this one mandate, and now we're not sticking to it. Because it's not the case. When we first started, Niels, we had marketing material, John Henry, and I remember it vividly. It was basically, here's what happens. Here's the performance of CTAs, trend following diversified CTAs, over the last 10 bear markets. We added value, 10, over the entire period. Not here's what happens when you have a 5 or 10 or 20% sell-off and it rallies back to new highs. It's kind of ironic to be concentrating on all of this stuff when the market's at all-time highs, because basically all of that gyrating around with these short-term systems was not necessary. But I tell you what was necessary. It's just what you said, getting your positions correct in those bonds and riding those trends and not getting out too quickly. A+.
It's funny you say that, and it just reminds me, I mean, this obsession with focusing on things that may only last for such a short period of time, rather than focusing on things that might last for years, meaning we know that most of the time equities go up, right? Yet there is this tendency to wanting to always drive it back to the focus on, okay, how did we do for those, few weeks market go down? I think it's different when you talk about bear markets, long stretch out bear markets. I think that's fine to be, comparing performance during those period of time. But I think these short-term corrections we've seen is not really that. We shouldn't worry too much about them. Anyways, that was a bit of a diversion just because of one little tweet that gave us some inspiration. So I wonder what the next tweet is going to do.
I found this one pretty interesting. It's back to taking losses and the psychology of the markets and how trend following adapts and adjusts and tries to get us going in the right direction. This was from a academic paper I read. Investors tend to hold on to the stocks that have made either a negative return since last login or since the purchase. So they're not even saying I have a losing trade. It's losing since I last looked at it. Oh my gosh.
Yeah.
A negative return.
That's a new dimension.
Yeah. A negative return since latest login is sufficient to almost eliminate the conventional disposition effect in most of our estimates. So the only thing that can overwhelm your emotions more so than a losing position is it's losing since the last time you logged in. Wow. It's amazing. I love that.
I thought there's some someone mentioned the number of logins that people with, for example, Robinhood accounts do in a day, and it's mind-boggling. I mean, it's just so frequent you wouldn't believe it. I think we have a fetish for keeping very close eye on our investments, even though this is the funny part actually. Even with trend following, right? Returns can't be predicted from day to day, or even from week to week, But actually, when you look long-term, you probably have much more of a predictive power in terms of what returns are likely to be. So why is it we even bother about trying and looking at these things with such a short time frame? It's an interesting human bias, I guess.
One of the things that matches, I think, or ties into what you just said is one tweet that I really liked. It's one of the ones that you retweeted, Jerry. Is predicting the future is impossible. No one can do it. However, you can watch the numbers, develop strategies, and bet smart by Larry Hite. And I think this is, I've heard something similar in his conversation with Meb Faber 2 weeks ago. Maybe this is out of this podcast or this conversation with Meb. And this is so true. This is the difference to the casino, right? I mean, we don't know what's going to happen tomorrow, but nobody forces us to place a bet. We can stay out of the markets if we don't like the signals that we get. We're not forced to participate in anything or everything on every day. We can step back, reduce our exposure, come back in when things look better according to our system. That is such a massive advantage for us.
We could have a podcast totally just reading the tweets of Wayne and Larry Hite.
Yeah.
A lot of good stuff there.
Absolutely. Do you want to do another one or another couple of ones before we...
Yeah, I like this one a lot. I've thought about this over the years, and one of my new Twitter friends, Richard, he seems really smart, and he has another very good quality. He seems to agree with me a lot, so I like Richard quite a bit. He brought up an issue that I don't think we've talked about, kind of subtle. I told him I was going to talk about it on the podcast. Hopefully I get this correct. He uses much bigger words than I do, so we'll see what happens. Every trader can trade trends, but few trend traders are systematic trend traders. The difference lies in whether you hold meaning in a simple price pattern itself, or whether you find meaning in a market principle that can be applied using a systematic, diversified process. So I really like that because he's basically saying what we do with all these rules and building up this strategy. It's so many different components, longs and shorts, and the different markets, and the money management with the position sizing. And it's like building a very complex home. so many different parts. That's way different than looking at a chart haphazardly or just randomly saying, oh, I'm going to buy that if it goes up. It's in an uptrend, so I'll just buy that. So that I don't think is as good as what we do, of course, which is forcing everything you do through this diversified, systematic trend following approach and trading this fixed universe of markets and taking all the trades and following all those trends versus sort of looking at a chart randomly.
So would you say, so the difference is in another, just for me to be sure I understand it, so it's the difference between embracing the full process versus just part of the process, right? So we embrace the full process, all the bits and parts, and some of it we don't like and some of it we like more, but we take everything because we know that's the right thing to do. And others might just cherry pick and say, yeah, okay, here I can see this trend, so I'm just going to do that, but forgetting about money management, forgetting about, taking their losses and all of that stuff. Is that kind of where he's going, do you think?
Yeah, and I think it's the lack of a process that makes you have the discipline and carry out the trades over a certain group of markets all the time. And it kind of gets back to that first tweet where, all-time highs, we should be bullish because it's all-time highs. That's an anecdote. That's just like making this claim. Is that part of your process? Is that part of something you've back tested? Does all-time highs work? Can you do better than waiting for all-time highs? And so it's a casual observation maybe of markets that they're in this trend or that trend versus a serious systematic process. What do you think, Moritz?
I agree with all of that. I probably need to do the jolly monger and say nothing to add. I agree.
Good stuff. There's some good nuggets coming out of Twitter this week, I would say.
Yeah, so let's we can do more, or we can finish with this one. I like this one a whole lot. I got this from a stock manager. Probably, I think he does like trend following a little, maybe uses a little bit of trend. It goes, a long past fails to plumb the depths of possible futures. Many events are possible which have never happened before. Diversification offers an effective first line of defense against low likelihood but large impact scenarios. Then I say history does not equal the future. And we've talked about this a lot, I have, and then I think it's somewhat confusing and sounds contradictory to sort of say, well, you guys are doing these back tests, you're looking at history of these trades, 30 years, 40 years of back testing, but now you're telling me that what's going to happen in the future may look different than this back test. Yes.
Yeah, I mean, it's the kind of ongoing discussion about, what's possible and what's probable. And of course, if it's very vivid, we think it's possible that they will happen. But it may not be very probable. Usually these very vivid events don't happen very often. Same with equity crashes, right? They're incredibly vivid and painful when they happen, but they don't happen that often. So it's a very important concept, which again, the process that we follow takes into account, so to speak. And, you talked about the fact that we look at backtest and we take comfort in backtest, but then we also say that the future will be different. And that may, to some people, sound confusing. But I think the point of all of it is that, it's always different. And so we build portfolios. We look at the trade stats. We look at trade stats in different time frames and different time periods. And the consistency within that is really what's important. And that gives us confidence that whatever the future holds, our systems, our models will be able to cope and adjust to deal with that as well. Not great all the time, not great every month, not great every quarter or even year, but in the long run.
The longer we play this game of trading, like you say, Niels, the greater the room of possibilities, right? Literally anything can happen. It's almost guaranteed that if we trade long enough, something absolutely major will happen. And in fact, there have been so many things all happening already in the past that we tend to forget about them unless they have been like super monster events, right? I mean, but I'm just thinking about, when was it, 4, 5, 6 weeks ago when we had this attack on the oil production facility in Saudi Arabia. Massive spike up in crude oil. Didn't really do much to our portfolios. It's a major event in the markets, in the oil markets at least, and maybe in a couple of weeks or month, it doesn't even cross my mind anymore. I mean, things like that happen, and it's like I say, it's almost guaranteed that even more severe things will happen in the markets as we continue trading that. So what is our line of defense? There's two. Diversification is one, right? And the other one is trading in the right size. You cannot have, even if you're diversified, you cannot have an overly great exposure on one bet vis-a-vis another. They need to be equally risk-sized, if you will, to equalize your losses and have a more balanced distribution of probabilities going forward. That's really the only thing that we can do. And then just enjoy the ride and see what comes.
One of these days we're going to be asked the question, how did you know that stocks were not going to go up for long periods of time? Years and years, they don't go up. And the only thing that's working is the currencies or the commodities or some shorts. And we're going to say we didn't know. We had no idea. But we just came in with more of a risk-based approach with maximum diversification in our rules because all of the systems we have and all the data we used, they too were run over periods where different things were happening, things that had never happened before. So these systems, they have a way of navigating that and getting on board with the trend, protecting the capital, regardless of what the fundamental facts are in the history or in the future. So I think history is not a good guide, but a 5,000 trade sample size is a very good guide on how to navigate the future.
Right. And based on that 5,000 trade sample size, that's what you always say, Jerry, is every trade has the same expectation. That is 100% correct. And yet we say that, and when we put on a trade, we have almost zero. Well, I have zero belief in anything or conviction in, what that market is going to do. It's just, I think the more you put yourself away from that thinking, the better you are. Just, view it as a neutralized or some sort of objective bet in the markets. There's no belief in any of those positions.
It reminds me of, so on this 14-hour long drive on Thursday, I started out listening to another audiobook, actually, from one of my previous guests, actually, Daniel Crosby, who wrote the book, The Behavioral Investor. And he says something along the lines that, good investment strategies has to be empirically supported, theoretically sound, and behaviorally rooted. And those, of course, are criteria that trend following really meets. But you could say the same about value. I mean, the value probably meets that as well. But it doesn't change the fact that from time to time, these strategies will be very difficult to hold. That's just the way it is. But the data, the evidence, it doesn't lie. And certainly in our case, for the trend followers, I guess the trend followers the fathers of trend following, they just decided to play the odds and ditch the story, and of course it hasn't worked out so well in terms of making it a huge strategy in terms of assets under management, but I think it's probably served the investors who invested in these strategies really well, that's our focus, so anyways, yeah, lots of good stuff.
There's a couple of funny ones that Larry, he's pretty funny on his interviews, and he's doesn't have a good filter. But one of them was, I retweeted this, but then I listened to the video and I grabbed this quote. He says every trader should have their exit strategy set in place before they even start trading. You should never allow painful investments to linger. And then he says, let's say you're on a date and your date has terrible breath. You don't want to linger. So I thought that was pretty funny. It's good to have a guy like that talking trends, and I think one of his points in life is, in general, is that trend following works in all areas of your life. Take small losses, go with the trend, add to winners. You want to get rich.
Yeah, he does actually relate his trend following philosophy a lot back to relationships and marriage and all that good stuff. So
well, he's got many years of experience, and that comes to show. It's really great to hear these things.
Yeah. I actually listened also to his audiobook on the flight back from the New York. So he's it's funny. It's a really funny ride or a book. So good stuff. Should we take a couple of questions, and then we may end up with one final topic that came across my desk, which I'm sure you have some strong opinions on as well.
Yes.
Good.
Okay, so the first question is from David. Thanks for sending that in, David. And by the way, as usual, if you have a question for us, you just send to info@toptradersunplugged.com, and we do our best to get it out in the next recording for sure. But David writes, when designing the bearish side of a strategy, should one ensure the strategy is the exact reflection of the bullish side? For example, if the long entry is a 100-day high, should the short entry be a 100-day low? Or do they end up being different, like 100-day high to get in, 50-day low to get short? And then question B, should one expect the bearish side of a strategy to perform as well as the bullish side? Or would the bearish generally underperform the bullish side, even if it produces a positive return? So those were the first two questions. Moritz, what's your view on this?
Well, I'm a simple mind, so really, yes, it is symmetrical for me. I enter the shorts using the same time frames as the longs, so it is symmetrical in that respect. I'm not saying that I'm long at the 200-day high, but in order to go short, it's the 205-day low or something like that. I don't do that. It's the same window. And then in terms of the outcome, the P&L outcome, it is, and we've mentioned that before in this podcast, it is skewed, I think, for the three of us towards the long-sided trades. Now, what does it mean? It means, when you look at equities, there's a long bias in equities. When we look at the bonds, they've pretty much just gone up for the past decades, right? So the long positions will have made more money than the shorts. Now, you may come to a different view with respect to commodities and currencies. But what like my thinking on that is, it is still that the trades have the same expectation. And as we've said before, the longer we stay in this game of trading, we may enter a period when our short-sided trades start to become more profitable than our long-sided trades. So I don't want to rule it out. I don't want to make a firm statement in trend-following world saying that long-sided trades will always do better than short-sided trades. Because if I make this firm statement and really had that core belief that this is true, then really I would have to change my system and start favoring longs versus shorts. And I don't do that. I stay with that neutral view of giving every trade the same risk, every trade the same chance to contribute vol and P&L to the portfolio. So I'm agnostic, and I don't want to make the forecast that, say, for the next 20 years, the long trades will make more money than the short trades.
Jerry, any thoughts?
Yeah, I agree. Definitely gets back to cutting your sample size in half if you treat the shorts different from the longs. I definitely think that it's also a situation where we have no reason to believe that the shorts will continue to be worse or not as good as the longs. So anything can happen in the future. So I think it's a big edge and the stability and robustness of your strategy to have that mindset and that philosophy when you build your systems.
So it's like parenting. Really, you should treat your children equally, and you should do the same with your trading strategy, right? I mean, not surprising, David. I agree wholeheartedly with Moritz and Jerry. I'm noticing in your email, David, that you talk about when you design your bearish strategies. I wouldn't design bearish strategies in particular. I would just design strategies for the markets. Who knows if they're going to be up and down? I think people forget that from 1965 to 1981, for example, U.S. equities were actually down 6% over that long period of time. So, and of course we know that the decade from 2000 to 2010, net, equities were down for that period. So yeah, let's time frame is very important, and therefore design something for the long run, not just to fit a certain market environment. Anyways, but thanks for your question. Next question is from Walter, and it's about position sizing. He writes, I was wondering if you have limits on position size for individual contracts. If you do, how are they determined? Do you have an enforced minimum level of volatility when calculating positions? I'm thinking of the Swiss franc in 2015. I think it was when the cap was lifted and it shot up by 20 to 30% in a day. A hard cap on position size or minimum volatility level would have prevented having huge position in the franc. Just wondering how you guys deal with this. Can I come to you again, Moritz, first? Just get your thoughts on it.
Yes, you can. So those volatility floors or minimum ATRs, if you will, depending on how you look at that, I do have that active on certain markets. And it's one of the things where kind of like, why is it in there? Hasn't been in there in the system in years prior. But to me, it is a risk mitigation thing. Where do I have it? I have it in the short-term interest rates. I also had it in the Swiss franc, which is kind of like a managed currency. Well, definitely back in the 2014-15 period before that break that was just mentioned, it was a severely managed currency. So I have that in order to protect myself from those large moves. But I don't have it in the majority of the markets. So I don't have it in the bonds. I don't have it in the equities. None of that. It's really in those markets which have super, super low vol.
Why not actually just have it in all markets? I mean, if it doesn't get hit, it doesn't get hit.
I could. It's just, where I have it, the level I have it, those other markets aren't there yet. So I don't want to rule out that, if, say, for instance, the Bund started to become so low vol, maybe I will, place the same cap on that market, but the other markets just haven't been down there yet.
Right. Okay, makes sense. Do you use it as well, Jerry?
Oh, I think that's a pretty good idea to have a max position for the low vol markets, or not trade them, or minimum ATR. Just a couple. I've gone about it in different ways. It's not optimal, but it's probably a good idea. But I just, in general, I'm going to size the Swiss franc and all of these markets just based upon their correlation to other markets. So I'm going to have I look at the euro, the Swiss, and the Swedish as being kind of correlated. So I scale those trades back a little. But so yeah, just it's correlation, and it's the same market. Is crude heating oil, unleaded kind of similar, silver, gold, platinum kind of similar. So I'm not going to be able to do too much if something crazy happens in the Swiss, apart from just luckily sizing it smaller because it's correlated to the euro. But if something else happens somewhere, I'm not interjecting a fundamental reason that this is dangerous. I'd probably kick it out of my portfolio if I felt like liquidity or crazy stuff was happening. But there has been crazy stuff like in Mexican peso, Russian ruble. So I'm subject to crazy stuff happening to some of my positions. But my only defense is I have 100 other markets, let's say, something like that.
Yeah. No, I mean, I think it makes sense, and we do the same. And the other way you can do it, you don't have to impose necessarily a minimum, but you could have a long-term volatility level that you say that's if the short-term vol is lower than that, I just use the higher of the two. If you want to take into account that some markets can go through low volatility periods, but they may not reflect the long-term level of risk in that market. So there are many ways of doing it, Walter, but I'm sure you can hear from the conversation that having something to prevent you from, silly exposure is always a good thing, for sure. All right, final question for this week is from Niels. And let's see if I can get this right. Here is my question. I hear you, Mr. Parker, Mr. Hyde talk, and others talk about small losses. I'm not sure what that means. What is a small loss? I usually think that a small loss is 1% of a position. Now, I don't think you mean position. I think you mean account size here, Neil. I sometimes might have it slide a bit to 2%, but my rule is usually 1%. And sometimes I let the market take out the position if at about 2, but usually if it's more than 1%, it's due to a missed placement of a stop. And I just feel like letting the market stop it out for me. And if I break the rule to 2%, okay, I'm just reading it, Neil, the way you wrote it, so I hope we get the right gist of your question. And then you go on to talk a little bit more about these rules. But I think we can just narrow it down to what are our thoughts about a small loss, what is a small loss, and so on and so forth. But of course, just reading your question and not necessarily reading it out loud, all of it. But I think the first thing I notice is that a stop loss for you is not necessarily a hard stop. It seems like you can let things, slide a bit. So that's probably the first thing the three of us would argue against. I mean, a stop is a stop. You shouldn't change it. You should follow your rules and have it and treat everything consistent across your trades. Consistency is incredibly important, actually, if you want to have success in trend following. So don't sway away from your stop loss. If it's set at 1, keep it at 1, but do it for everything you do. Even though, and we'll hear what Jerry and Moritz has to say in a second, but the 1% seems still large in my view. Of course, I don't know how many trades or markets you trade. 1% seems healthy. 2% seems excessive in my view in terms of loss on a single trade. But let me turn it over to you, Jerry, and hear what your thoughts are on what is a small loss.
Yeah, it's a percentage of your assets under management. So 1 seems too much for me. And as far as this question goes, this is the being consistent and having a rule and not breaking the rule is the best advice we could give. Although I would caution, though, if you have concentrated positions on and you think you're taking small 25 basis point or 50 basis point loss, but if you overtrading the certain sectors or groups, you may be taking a 1% loss. I've done that before. So 25 basis points, 50 basis points sounds good to me.
Yeah, to me, small loss is if the market hits my initial stop. And like you say, Niels, that stop must be honored at all costs, right? So say it's 50 bips of your equity. At that point, I have that small loss. And, I have so many of them, countless almost. And I love them. It's kind of like, placed a bet and it didn't work. Fine. And, but there will be the other bets which, don't lead to small losses. They lead to large gains. And those I love even more. What I want to say is, those positions which develop in the right direction, you may have a lot of open profit on them. And then on that open or off that open profit, you can give back more than, say, the 50 bips, which I've just mentioned, right? So from a certain peak in equity or from a peak in open profit in a certain position, you can have a larger loss than the 50 bips. But then the question is that really a loss? It is not a loss of your core equity. It's just a give back on open profit, which, doesn't mean that it needs to feel good, but it's an important distinction to make.
Could also be a loss from the last time you logged into your account, Moritz. You never know.
And certainly, right. Then maybe I need to stop logging in, just, blocking myself off.
Okay, good stuff. Well, I hope that was useful to all of you sending questions in. And as mentioned, if you want to get us to comment on some of your questions or ideas, just send it to info@toptradersunplugged.com. What I could do now is just as we normally do, just run through performance. But I do want to, before we end today, if you're up for it, guys, I do want to comment. I do want to discuss a little bit a great piece of analysis that I thought of that came out also in October. which is by Abbey Capital. So the good people at Abbey Capital been in the business for a long time. They allocate to trend followers. They actually started out as a trend follower, but now they allocate to trend followers, and I think they have some really useful views and analysis on some of the things that we also get accused from on a regular basis. So let me just run through the performance, and let's get back to some interesting conversation, I hope, in a second. And of course, these numbers are always as of Thursday evening. I think Friday was a mixed day. I don't think there was any particular pattern where the managers were up or down. So since it was as of Thursday, it actually also happens to be the full month of October. So the numbers you'll hear me quote here is the estimates for October. So the beta 50 index ended the month of October down 2.57, but still up 6.38 for the year. SocGen CTA index down almost the same, 2.53, up 5.85 for the year. The SocGen Trend Index down 4.29 for the month of October, up 8.77 for the year. The SocGen Short-Term Traders Index pretty much flat, down 1 basis point for the month, up 1.82 for the year. And the Bridge Alternatives, the Flat Fee Index, down 3.49, but still up 8.03 for the year. So in line with, I guess, the experience that all of us had in October. But I wanted to, if you don't mind, I know you may not have read the article, but I know you guys have opinion about this. So Abbey Capital published this great analysis where they go into some of the key arguments that we've heard recently when CTAs are pronounced quote unquote dead, or the strategy doesn't work, etc., etc. So there's always some of the same reasons being mentioned. One is that there's just too much money in the space. Another one we hear often is that trend followers we're now being front run or gained by other strategies, shorter term strategies. And then also that, and this was also something I think we talked about earlier in the year when Bloomberg talked about how markets were becoming too fast for trend followers, and Trump's tweets were causing the trend followers to simply have become too slow to react to all of this. So what Abbey does very well, they go in and they deal with each of these points, So their conclusion on these 3 points is that there's no justification or data to support that. In terms of too much money in the space, they go in and they first of all look at the CTA space as a whole. How much is trend? How much is non-trend? Then they volatility adjust the AUM, so to speak, back to, I think, 2008, 2009 numbers. Because the space may have grown nominally, but we know a lot of managers have levered down their strategy. So on a volatility adjusted basis, they find that the industry has hardly grown, or the trend following space has hardly grown, whilst the underlying futures markets that we trade have gone up by several 100% in volume and open interest. So that's the first thing. And then they also deal with this, whether markets have, whether we are being front run, et cetera, and they do some analysis to, and I don't remember all the details, but they do some analysis to look at these things, and they are able to conclude based on that analysis that that's really, again, not really founded in any of the data. And the same goes for whether the markets have become too fast for trend followers. So without going into all of the details, but for now, as a just discussion point, now what they conclude, and I'd love to hear your take on that, and of course on all the other points, what they conclude is that what is more likely to be the case, or the reason why performance overall have been lower in the last decade, maybe so from 2010 and to now, compared to maybe the noughts and the 90s, is that there has been much less variance in global GDP, meaning the last 10 years, central banks, policymakers have managed to keep global GDP relatively stable. And with stable GDP, you have less major trends, major moves in some of the markets that often react to this, and which could be both on the commodity side and on the financial side. To me, that seems like a very reasonable argument. I've kind of seen the same on my own trend barometer. And actually in October, I had kind of the lowest reading that I've seen in many, many years. So I would be a subscriber to their argument that is more likely to be the reason compared to some of the other points that they make. And just because you've had a 10-year period of maybe lower performance, that doesn't mean that you can't have strong performance in the following 10 years. And I wanted to just put that in perspective in terms of equity markets, because and this is U.S. equity markets. I mean, from 1929 to 1943, if you had invested $1, you would only have $1.08 after that 14-year period. But from 1944 to 1964, that $1 would have grown to $10.8. So massive performance. Then the following period, from 1965 to 1981, you would have lost 6%. That dollar would have fallen to 94 cents. 1982 to 1999, again, very bullish conditions. That $1 would have grown to almost $12. And then we had 2000 to 2010, where the investment of $1 would have actually fallen to 91 cents. So it shows you that there is no reason that just because you've had a 10, 15-year period of low performance that you couldn't have very, very strong performance the following period of time. And I don't see why this would be any different from an asset class or quote-unquote investment strategy like trend following. Anyways, that was a long introduction to this, but I would love to hear your thoughts, knowing full well you haven't read all the details, but I don't think we need to go into all the details. But just in general, your opinions, your reactions when you hear some of these arguments being put forward by someone who clearly understands the space, have been operating and allocating to managers, CTAs, trend followers for many decades.
I mean, I'm not as interested in trying to figure out why it's happened. I just think it's happened and it's a bummer, and we have to look at our systems and our approach to see, primarily if we've missed any big trends. We've missed some great opportunities, which I think this might be the third or fourth recent paper I've read, basically coming to the conclusion that we haven't done anything necessarily wrong, or we shouldn't expect good performance in the future. Just haven't had those big trends. As I've said, joking around, when I was 25 and I heard about trend following, I immediately thought it was wonderful. Diversification, shorts, fantastic. Knew nothing about it, but I just thought, it boils down to, are these big winning trades going to pay for the small losses? And if that's the case, then it would be great. I'll make 100% a year. And so I think that sometimes they don't. They don't pay for the losses, or they pay for them, but that's about all they do. And the returns are smallish, meager. So I just want to make sure I'm doing my part to make sure that I'm trading the best I can and not missing good opportunities, which I guess we haven't had many, but we probably will, and we'll keep doing it. And as I've said many times, every part that makes trend following great for me, the risk control and the capital preservation without sacrificing too much of the ability to make good money, I'm not willing to give up on any of those things. I'll just continue to make low money or no money for the rest of my career if the alternative is abandoning the core principles of small losses and following price.
Yeah. So what did we have there? We had the argument of, or the opinion on the front running. I'd say, show me the data, show me the evidence. I haven't seen anything that's conclusive. As long as there's no data and evidence on us being front run, I'll just file that away as an opinion. It's one opinion of many. So not worry too much about that. Then shorts trends becoming more erratic and markets becoming shorter term. This is, probably some recency bias on the events which we had in the past year, 2018 in particular, where we as longer term trend followers got kind of like hit on the wrong foot. But relatively small sample size, if this is what people are referring to. When you look back, I assume over longer periods of time, all those markets and all the data there must have been reversals in there as sharp as the ones that we had in the past year. We probably don't have them on our radar screen anymore. It also doesn't mean that going forward, every correction is going to be as sharp. We just don't know how markets are going to pan out, and I have no reason to ditch my trading system because of that. And then we had the argument about the AUM. I always like that question. I'd like to know for myself. We can look at the CTAs, trend following CTAs, and look at their AUM. It doesn't tell us anything about their notional trading level to begin with. So vol adjusting that, as you say, Niels, is one step toward that. But I think a lot of things are mixed up here. There are some CTAs in there which are not trend followers. There are some CTAs in there which are short-term trend followers. We're missing all the guys like, for instance, my firm, where we're trading internally and we're not reporting it to any database. So how many of those firms are there? How large are there? How large are the private traders in our private accounts, and what do they do? So it's very difficult, I believe, to find the right number. It can only ever be ballpark. But like you say, even if our number were double than the number that you've mentioned, it would still, in my opinion, and I may be wrong there, this is my hunch, it'll probably still be a small enough fraction of the overall market so that we're not going to be impacting the overall, market system, if you will.
Good. If I may just add to that, even if there were a lot more money in trend following, it's not like trend followers per se trade against each other, right? We kind of trade in the same direction. So one, it could help. Now, it could, of course, mean that the turning points became a little bit more rapid, and we might see some more slippage. But I bet you, if you went and asked all the top managers today about their slippage, I bet you they would say that they've been able to improve the slippage and not actually seen any worsening of slippage.
I agree. Look, and we're looking to diversify. We said that before. We're looking to diversify across time frames. We're looking to diversify and not just hit the market with one big large order and go to market with that thing. So we're in our own interest, right? We're looking to kind of like smoothly go in and smoothly go out. So I'm not too concerned about that. And then the last argument about the GDP. Well, we know economies, they expand and they contract, and that may cause trends. And if I remember correctly, the argument was that in the past 10 years, maybe because of globalization or
central bank
politics, which kind of like has been the same across the globe everywhere, that, the differences between economic growth in different countries hasn't been as divergent or as strong as it's been in the past. And maybe that's true. But okay, fine. I cannot worry about that. On that argument, I sit firmly in Jerry's camp and just go like, well, maybe not. I don't know. Doesn't really matter. It's part of the history now. We need to look forward.
I will offer a little dissenting view, which is that sometimes for CTAs, it's just part of the equation, the AUM. Because if the vol gets low in the S&P, the same trader with the same AUM can have twice the position or 3 times the position. So I think that is relevant for CTAs. Some of these massive sell-offs in the S&P, Dow down 1,000, and I kind of thought, well, maybe the vol targeting people are responsible for some of that massive movement because the S&P did slow down right before then, a couple of years ago, and the vol was really low. So those positions might have been a lot larger, increasing larger and larger, totally based upon the vol, nothing to do with the AUM. And then again, I think it could be a situation as well. Even though I agree with everything you said, I think also that it doesn't matter what we're doing or how small we are if there are algos out there who want to take advantage of what we're doing, and it's in their best, and they can make a little bit of money off of it. It doesn't even matter if we're really, really small. They'll make a little bit of money out of trying to figure out where our orders are, run those orders up, and then get out, and then we're going to be taking a small loss. They'll sell it to us at the high, and then the market will go down. Lead, I bought lead one day. It's down big 2 days in a row. I mean, I'm not paranoid about it. I'm just saying, if it's in someone's best interest to do that, they can do it. Just set the computer up and it'll do it. So there could be bad people out there who want to find our orders and figure out what we're doing and harm our performance. And it can be very subtle. The bond sell-off, I mean, these massive sell-offs after these trends where we get just absolutely destroyed, crazy outsized moves, it just happens, or there are people setting off those stops, and we're going to make a lot less money on the big trends. Well, I've said this before, so it's not predicting it. I'm not trying to be paranoid. It's just a fact.
Sure. I mean, and also I think one thing just to add to that, a lot of these sudden spike in volume and selling pressure and all of that, I mean, a lot of that actually also comes from the mutual fund industry. I mean, they have their robots or whatever it is coming in every day to adjust for flows and all of that, and that causes significant, either upside or downside, pressure on prices as well. So, I mean, it's difficult to pinpoint exactly where some of these triggers lie and where some of that flow comes from. But as both of you say, I mean, it's just part of how markets are, and our strategies have to be designed to, and I think they are. I mean, they are designed to cope with that. And that's why going back to our conversations last weekend in New York, I mean, to a large extent, what we do is we realize and recognize risk every single day. That's why our performance records are inherently volatile. Other strategies don't do that. So they look safe, but they may not be. So it's just a difference, I guess, in philosophy and implementation and transparency.
Exactly.
Good stuff. Thanks for sharing your thoughts on that topic. I hope lots of people will read the study and form their own opinion on this, if it is important to them to have a reason for being able to describe difference in performance in these strategies. Anyways, anything else you want to bring up before we wrap up our conversation today?
No, not from my side. Have a great week, everybody.
Yes, same here. Look forward to seeing you guys maybe early next year in warm weather in Florida. Absolutely. We have to persuade Moritz to come to Florida and not...
I think you may be able to do that.
Okay. It could be that promise of VIP basketball tickets. You never know. We can't go into too much detail, but they're out there, and
I know.
We are watching this space. Okay, good stuff. We hope you enjoyed it as much as we enjoy making these episodes for you. And if you feel you get any value from our conversations, please share it with one of your own followers or one of your own friends. We would be grateful for that. Also, if you have time to leave us a rating and review on iTunes, that really does help other investors discover the Systematic Investor series. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you as usual next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode